What mutual funds are, how mutual funds work, 10 things you should know about mutual funds. Mutual funds are one of the most popular ways for new investors to build wealth. Whether you own them through your retirement plans or you buy them directly or through a brokerage account, this guide to mutual fund investing was designed to help you understand what they are, how they work, and things you want to consider. Firstly, the basics of mutual fund, what they are and how they can make you money. So mutual funds are perhaps the easiest and least stressful ways to invest in the market. In fact, more new money has been introduced into funds during the past few years than at any time in the history. So before you jump into the pool and start throwing your money at mutual funds, you should know exactly what they are and how they work. So first of all, what is a mutual fund? Put simply, a mutual fund is a pool of money provided by individual investors, companies, and other organizations. A fund manager is hired to invest the cash the investors have contributed, and the fund's manager's goal depend on the type of the fund. A fixed income fund manager, for example, would strive to provide the highest yield at the lowest risk. So, mutual funds are divided along four lines: closed-end and open-ended funds. The latter is subdivided into load and no load. So first of all, closed-end funds. So this type of fund has a set of number of shares issued to the public through an initial public offering. So these shares trade on the open market. This combined with the fact that a closed-end fund does not redeem or issues new shares like a normal mutual fund, subject the fund shares to the laws of supply and demand. As a result, shares of closed-end funds normally trade at a discount to net asset value. Now, the open-end funds. A majority of mutual funds are open-ended. In a basic sense, this means that the funds does not have a set of number of shares. Instead, the fund will issue new shares to an investor based upon the current net asset value and redeem the shares when the investors decide to sell. Open-end funds always reflect the net asset value of the fund's underlying investments because shares are created and destroyed as necessary. Then, the load versus no load. A load in mutual fund speak is a sales commission. If a fund charges a load, the investor will pay the sales commission on top of the net asset value of the fund's share. No-load funds tend to generate higher returns for investors due to the lower expenses associated with ownership. Now, what are the benefits of investing in a mutual fund? So, mutual funds are actively managed by a professional money manager who constantly monitors the stocks and bonds in the fund's portfolio because this is his or her primary occupation. They can devote considerably more time to selecting investments than an individual investor. It provides the peace of mind that comes with informed investing without the stress of analyzing financial statements or calculating financial ratios. Here is an explanation of what you are buying when you invest in a mutual fund, or simply how a mutual fund is structured. So I recently investigated the process of starting a mutual fund. As I have been meeting with fund companies and banks, I have learned tremendous amount about how mutual funds are structured, including the arrangements that make funds work on a day-to-day basis. I thought it would be a great opportunity to share this knowledge with you so you can use that and look the man behind the curtain and see how your money moves once you have put it into a mutual fund. So let's understand the mutual fund company. A mutual fund is organized as a regular corporation or a trust, depending on which method the founders prefer. If the fund agrees to pay out all its dividend, interest, and capital gains profit to shareholders, the IRS won't make it pay corporate tax. This helps you avoid the double layer of taxation that is ordinarily present when buying shares of the stock. The mutual fund itself has only a few things: a board of directors or board of trustees, the cash, stocks, and bonds the fund holds, the contracts. Now, here the contracts will include custody, a bank that will hold all the cash, bonds, stocks, or assets that the fund owns in exchange for a fee. Then, the transfer agent, the people who keep track of your purchases and sales of the mutual fund shares. Then, the audit and accounting, the firm that will come in and verify the money is present and the mutual fund is worth what it says in the newspaper every day. Then the investment management or the advisor company. It is the company that manages the money and makes buy, sell, hold decisions. The investment management company is paid a percentage of the asset, say 1.5% in exchange of this service. They can be fired by the mutual fund's board of directors with very little notice and replaced. How the mutual fund process works. Let's say you have $10,000 you want to invest in XYZ fund. You download a new account application from the mutual fund's website, fill it out and mail it in along with a check. A few days later, your account is open. So here's a simplified explanation of what will happen. First of all, your check was mailed to the transfer agent. It was deposited into a bank or custody account. They will make sure you are issued shares of the mutual fund based on the value of the fund when your check was deposited. Then the cash will show up in the account and will be visible to the portfolio manager that represents the advisor's company. They will get a report telling them how much money is available to invest in additional stocks, bonds or other securities. Then the portfolio manager is ready to buy shares of a stock such as Coca-Cola. He will tell his trading department to make sure the order gets filled. They will work with stockbrokers, investment banks, clearing networks and other sources of liquidity to find the stock and get their hands on it at the lowest possible price. Then, when the trade is agreed upon, a few days will pass until the settlement date. On this date, the mutual fund will have the money taken out of its bank account and give it to the person or institution that sold the shares of Coke to them in exchange for the Coke stock certificates, making them the new owner. When Coca-Cola pays a dividend, it will send the money to the custodian, who will make sure it is credited to the mutual fund's account. The mutual fund will likely hold the money in cash so it can repay them out to you as a dividend at the end of the year. Now, how can you buy a share from mutual funds? 3 ways new investors can buy shares of mutual fund. Unless you are fortunate enough to have a net worth sufficiently high to give you access to an individually managed account run by an asset management company, the odds are good that you are going to do most of your investing through a pooled structure such as a mutual fund. In this tutorial, we want to focus on the actual how. Specifically, how you would go about buying shares of a mutual fund once you had made the decision that you wanted to own a particular fund. By doing so, we hope to give you a broader understanding of the mechanics involved. So you can buy shares of a mutual fund through your broker. If you have a brokerage account, Roth IRA or traditional IRA, or another account at a stockbroker such as Charles Schwab or Merrill Lynch, you can buy most mutual funds just like you would a share of stock. Simply go to the broker's website, walk into the nearest branch office or call your broker on the telephone and tell them the ticker symbol of the mutual fund you want to purchase and the total amount of money you want to invest. If you were buying shares of Coca-Cola, for example, the ticker symbol is KO. Mutual funds like stocks have their own assigned ticker symbols. Most brokers are going to charge you a commission or others fees to buy a share of mutual fund. Often, if the mutual fund is structured as an exchange-traded fund, they will apply the same commission that you usually do for stocks. In case of load mutual funds, commissions can run as high as 5.75% per annum with additional expenses. However, in cases of load mutual funds, it is possible that the load is offset by a lower mutual fund expense ratio, so the investor is better off over longer periods of time, which matters if you are taking the buy and hold approach. But we maintain there is almost never reason to pay a mutual fund sales load in today's world, where you can find a superior or comparable product without the added cost. In other ways, you can buy shares of a mutual fund directly from a mutual fund company. If you know you want to have your money invested in a specific mutual fund or in mutual funds that make up part of a larger mutual fund family, you can often open an account directly with the mutual fund itself. You fill out paperwork online, mail it in with a check, and tell the company whether you want to open a regular account or a special account. You can even set it up so that the mutual fund automatically makes investment for you by regularly withdrawing money from your checking and service saving account each month. This technique, called dollar cost averaging, can be a helpful way to smooth out the average price you pay for your mutual fund shares. And as you thinking goes through this is some academic questions to it help lower the risk that you put all your money in the market at a peak, such as the day before the dot-com crash or the Wall Street meltdown that started the Great Recession in 2008. The biggest advantage to buying mutual fund shares directly from the mutual fund company itself is that you often won't get charged a standard brokerage commission, meaning more money goes into your investment and is working for you. The downside of buying mutual fund shares directly from the mutual fund company itself is that it can be more difficult to transfer your holdings later or diversify into additional securities, including buying shares of the other mutual funds offered by other financial institutions. So I hope this tutorial gives you a clear idea about how to start investing your money wisely. Thank you so much for watching.